Okay, welcome back. Welcome back. Now, I know what you're thinking. You're thinking, wait a minute, this audience, this hall is only a third full. But that's normal after lunch. That's normal, okay? Why do you think that this slot in any conference, it could be anywhere in the world, why do you think this slot is called the graveyard slot? Stefan, you're thinking, I'm glad I'm not on this one. It's called the graveyard slot. You know why? Because you always have really nice desserts at the lunch. Did we like them? I don't know about you, but I loved them, right? So you eat all those nice cakes, you have one too many, then you want to have a little snooze. So you come back in the audience, you make sure you don't sit in the front row, you sit in the back, then you have a little snooze while the presenter is talking. Well, I can't do that, although who spotted me doing that earlier? Where's Faris gone? Where's he doing? Right, welcome back, everybody. I hope you had a good lunch. I know I did, okay? Thanks to the organisers and the hotel for organising such a fantastic lunch, right? Love that. We are going to press on with a topic that is guaranteed to beat the graveyard slot blues because it's so important. Like I said, it's about reference rates, replacement of LIBOR reference rates, and using them for hedging. And it's a panel discussion, okay? It's a panel discussion. And again, I'm not moderating it. So I'm going to go and have a little kip, English for slang for sleep, right? I'm going to go and have a little kip, right? And it's going to be moderated by someone who I hope is online with us. Axel Van-Nederveen, Treasurer of the EBRD. Is he with us?
Yeah, not bad in terms of, but I need to get my camera on. There we go. I'm speaking, you're not hearing.
I can hear you, sir. I just can't see you.
Well, that's probably better.
No, I'm sure you're a very handsome man. If you could turn on the camera.
It is on.
Oh, in which case I'll let you off. For some reason we can't see. But it's okay. We'll carry on listening to you. Do we have Aude Pacatte, also from the EBRD?
Yes.
Perfect.
Can you hear me?
Forgive me if I didn't pronounce your name correctly. Was that okay?
Perfect.
Ah, well, there you go. See? Right. So, and we have Ramzy Darwish from Bank Saudi Fransi. Do we have you, sir? No? I'm looking at the organisers. Have we, no? We have?
He's on.
He is on.
Hello?
Ramzy?
Yes.
Perfect.
Apologies.
No, not at all. That's great. So everyone is here. And the final panelist is here in person, Mr. John Ho, who needs no introduction because he was trying to proselytize that CBDC message earlier. No, couldn't forgive. Right. So I'm going to hand this over to the moderator, which is Mr. Axel, who is a treasurer, wherever you want to say, yeah, who is a treasurer with the EBRD, and he's going to be moderating a panel on the importance and challenges of developing benchmarks and derivatives for hedging in banks in frontier markets. Sir, the floor is yours.
Okay, thank you. In a sense, let's say maybe we'll skip that because otherwise we're going to run out of time. Because this is unfortunately one of these elements that I can talk about for hours. I think is absolutely fascinating if you love it. If you don't, I think it's probably best to, as you said, sleep at the back of the room. Now, the main thing that we actually want to do is and this is where we're using, let's call it the different expertises of the panelists. Therefore, this is my introduction to the panelists. So Aude Pacatte, who I know very well, I work very closely with. She's responsible for all our local currency lending operations. The EBRD lends in 23 different local currencies, from Mongolia to Morocco. And one of the key elements that we've effectively needed to do in order to be able to do our lending the way we would do it in in dollars and euros, is effectively you need to have money market benchmarks. Therefore, money market benchmark creation has been one of the main hobby horses that we've had, and Aude's been instrumental in developing 8 of them, including, so far in the region in Morocco and in Egypt.
My apologies, Axel. I'm sorry to interrupt. I'm wondering if it's possible to turn your camera slightly more towards you so we can actually see your face. Is that That's
No, but basically, that's the last thing you want to see. Let's say my office is much nicer.
I beg to differ. I beg to differ. I think that's a great view. Is that okay? Thank you very much. Please carry on, sir.
Okay. And I think that for us, basically, that for the development of, let's say, money market benchmarks as a starting point to develop derivatives is extremely important, because otherwise you cannot get, that's almost like the fundamentals of an ability of the banks to actually manage their balance sheets properly. Now, then my second panelist is Ramzy Darwish, and indirectly, I think he's extremely interesting to hear, basically, given his background. Let's say Saudi Arabia has developed its local financial system quite rapidly over the last 5 to 10 years. And I think Ramzy has been sort of very deeply involved in the development of the repo market and the importance, and that will reflect on it, the importance of either of a repo market, at least an active overnight market, to be able to develop a benchmark is crucial. He'll also basically refer a little bit back to, let's call it, the importance actually, how can you make, let's say, a repo and a repo framework work, let's call it, in a consistent manner that it connects both the Islamic and the non-Islamic part of finance, which I think, certainly for the region, I think is extremely important. And then John Hope, I didn't listen to his story on CBDC, maybe all the better, but I think John's, not just his, let's say, his legal background, therefore the importance of, let's call it, some of the basics of netting is what we'll briefly go through, but I think the other part is something that we've sort of seen, is basically how do you actually connect offshore and onshore? Why is there a difference sometimes between NDFs and the onshore market when it comes to, let's call it, the implied interest rates that are part of both? What are some of the elements, what are the issues that he's been trying to deal with in some of the work he does on cross-border payment systems? And he might even give some insight as to why we might not want to have, let's say, too much control over things. Because control is not always good. Now, with that, maybe I'll start with the opening question. Is really, and that's to Aude, basically, why should we even bother thinking about derivatives as something important in developing a financial system? Aude, over to you.
Yes, thank you. Good afternoon, everyone. So, interesting question. So, why do derivatives matter? Derivatives matter a lot, in our view, to enable the financial system and to basically do risk management in a manner that they can offer the right products to support the economy. So they're crucial, in our view, to give the capacity, to provide the capacity to the banks and to the financial actors to manage their risks and to basically fulfill their function in the economy, to provide the right type of instruments or products to the real economy, so that the real economy doesn't have to bear the market risk that the financial intermediaries are supposed to bear and manage themselves. So why am I saying that? Is that because the derivatives, and we're focusing mainly here in terms of vanilla derivatives, very simple ones to manage FX risk and interest rate risk, they allow the financial intermediaries, the financial market, to engage by managing market risk, to engage into maturity transformation, to provide more flexible loan features or financing instruments to the end borrowers with the interest rate features that they are asking for. So they can, for instance, that allows the the banks to take maturity, to engage and to take maturity transformation risk, and to offer longer term interest rate, fixed rate loans to their clients that they would be able to, or then they are able to, when there's no interest rate derivatives available for them to manage this risk. So yes, interest rates, we at EBRD, we particularly focus on interest rate risk that rely on, and that cannot develop without an interest rate benchmark, which is the starting point that Axel mentioned earlier. But the interest rate risks are very crucial to be able to offer long-term and flexible and affordable loans to the real economy. They allow to manage interest rate risk independently from the actual on-balance sheet items in a bank. So they allow basically to manage independently assets and liabilities, to lock in opportunities. For instance, a bank who sees an opportunities to issue a fixed rate, to borrow on a fixed rate basis, they don't have to wait to have the offsetting item on their asset, so like a loan disbursement, to match it. So they can proactively manage their balance sheet, so they can manage the cash independently of interest rate risk. And this is extremely powerful. It also allows them, because they can manage interest rate risk independently, to start building liquidity pools, and liquidity pools to warehouse excess liquidity, to have a prudent approach to liquidity management, and to take maturity transformation, and to offer longer term financing to the economy, as I was mentioning. And last but not least, they are extremely flexible instruments, much more easy to lock in than cash or products like bond issuances if you need to fund some loan disbursements. They of the counters or on exchange traded. There's different venues depending on the countries, but they're very flexible and they're very efficient in terms of pricing. The pricing wise, they save from having to cross the bid offer spread of the cash curve, and also because of the closeout netting, which I'm sure John Ho will talk about later, that you can net the exposure and reduce the exposure of all your for a single counterparty with of all the instruments that the derivatives that you would do with the same counterparty. So for pricing wise, also they allow to reduce the cost to manage risk. And also, obviously, if you cannot manage risk, you won't charge as much of a risk premium to your clients. So overall, they're efficient. They're allowed to improve the pricing. They're allowed to extend the maturity of the products offered to the client. So they're very key instrument for financial sector to offer financing to the economy. And I'll stop here.
Yeah, thank you. Yeah, so as you can hear, we think that derivatives are key. Now, let's build basically what are sort of the building blocks that you need to actually be able to scale up a derivatives market. John, do you want to sort of jump in with regards to, let's call it the legal background?
Thank you. I think Axel, thank you, Axel. I think Aude have provided a very good framework in terms of the role of derivatives, right? So some people who are not close to financial market will say derivatives is the weapons of mass destruction in financial market. But like anything else, you know, derivative used prudently in a manner that is for hedging, in a manner that is risk reducing, does achieve, provide a tool to manage risks. So when you look at credit counterparty risk, there are two ways to do it. If you lend uncollateralized, then you're always subject to exposure with respect to the counterparty. But if you lend on a collateralized basis through either cross-currency swaps, finance-linked swaps, typically parties document such exposure with respect to OTC derivative based on international standard agreement like the ISDA master agreement with respect to collateral support deed and spread support document that is backed by sort of legal opinion in jurisdiction that have clear netting laws. I already mentioned the benefits that you reduce your credit counterparty risk, you reduce your operational risk as well, and also it frees up credit lines for parties to trade. And one of the key risk mitigation as part of FSB key initiatives is employing risk reduction measures. And one of the methods is, as we mentioned, the use of prudent derivatives for hedging purposes, together with collateralization, does allow to enable a sort of development of robust derivative markets, because derivative is a leverage exposure. However, used prudently with legal documentation supported by opinions does provide for legal certainty. Now, having said that, there are certain markets, especially also in Middle East, a number of countries may not necessarily have clean netting jurisdictions. What parties tend to do is a couple of methods where they take collateral completely offshore and have an arrangement that allows for a set-off or netting before insolvency, where post-insolvency, some of them rely on the passing of new legislation to provide certainty. Some of them resort to financing structures. that do allow for a pledge or a set-off to be applied. So there's a number of methods out there available, but the key point is legal certainty, standardized documentation, backed by a legal opinion is key towards providing confidence and certainty in this market. Axel.
Yeah, thanks, John. Which is sort of part of the reason why that's almost like one of the first things that the EBRD does is basically it is promoting, therefore, the implementation through, let's call it TA or legal reform, in order to try to get a clean, therefore a clean netting opinion possible by completely either introducing a specific derivatives law or making changes to a whole raft of underlying laws in order to ensure that there's legal certainty about closeout netting under bankruptcy. And it is a crucial building block, but it's not enough. We have a number of jurisdictions that we work in that have had clean netting opinions for 10 years and still nothing has happened in terms of derivatives market development. So, Aude, maybe if you can sort of imply a little bit what are some of the other building blocks necessary to actually get a market going?
Yes, sure. So as Axel just said, closeout netting is a must, but not sufficient. And even to start at least interest rate swaps where exposure is not big, you can start transacting derivatives without the netting, because the netting opinion allows to net exposure. So if you only have a small exposure at the beginning, you can even get started without it. But what we found in some countries that even with the desire to get started, whether the legal opinion is netting opinion is there or not, is you have a number of stumbling blocks that actually do need to be overturned. Or they're not necessarily there, but they're key stepping stones to the development of the market. So first of all, regulations. So the law is important. Regulations are extremely important as well. So they can play a key role if, in the sense that they may be some regulations simply advising that hedging is only possible with a specific authorization for every single transaction, or that it's possible in some certain cases only if it's for hedging a future cash flow, hedging an export in the case of FX derivatives, or specifying that only a few specific market participants, restricting the derivatives to specific market participants. So there's all sorts of regulations that can be constraining the development of the derivatives market, and it's very important to have a look and to ensure that they're not over-restrictive. And especially, I mean, I'm talking about very basic regulations here, but there's also the temptation of imposing the regulations, the regulatory framework which was developed after the GFC on overall derivatives markets at the global level. And there's a temptation to replicate the rules, which are not a good, well, they're not necessary in a market which hasn't even started, right? They're actually, the risk is by copying and pasting regulations done for big markets is that you're going to restrict the development of the market altogether. Like CCPs, there's the big push for CCPs in many countries, and CCP does not make sense unless you have a significant market, because there's significant costs, and it's really not a good way to start a market. So
sorry, may I just forgive me, please? Apologies. May I just jump in quickly on that? Are you advising or suggesting then that where there is a frontier economy and you want to develop a liquid derivatives market, the way forward should be bilateral collateral like it always was until CCPs came about? Is that what you're suggesting?
Well, OTC derivatives to start with is a much better, easier way to create liquidity. Yeah. And until you have significant volume, a CCP, I mean, there's a trade-off, right?
Understood, yes, understood. No, that's what I thought. No, thank you. Please carry on. Thank you.
Sure. Other potential things to look at, tax and accounting. So we've seen jurisdiction when actually the tax treatment of derivatives is not clear enough, and the participants are worried that if they don't treat the cash flows in a specific manner, they may be liable for fines, and therefore it's actually a big hurdle to the development of the market. We mentioned, and we're going to cover further the point of benchmark. You do need, at least specifically for starting interest rate OIS derivatives market, you do need an interest rate benchmark. For that, you need supportive monetary policy framework, because you need a money market that reflects, that is, if you have FX targeting regime, it's often more difficult to anchor the interest rate to the domestic to the monetary policy target, and therefore to have liquidity in the overnight money market. But the key is really to it is possible, but it is more difficult. But you do need a benchmark to develop derivatives, whether it's secured and unsecured. Doesn't matter in general, because you can see in the most liquid markets, you've got both. For instance, SOFR is a secured benchmark. Sonia, Esther, they're unsecured. It really should reflect, generally the decision to go for secured or unsecured depends on the actual underlying liquidity of the market. It goes for it reflects the actual structure of the market. So it's often a consequence of the the way the central bank operates its monetary policy. Beyond benchmark, so that's the starting point of a yield curve. So you do need a longer term curve. So you do need, as the market develops, it creates an interest rate yield curve. You do need that curve to price and value the derivatives. You do need risk management policies in the organizations. Risk management systems. We've seen countries where the lack of risk management system capable for needed for booking and valuing the instruments, what is actually the hurdle to the development of the market. And last but not least, I think capacity building. The market altogether, and every single actor which participates in the market, at whether it's a trader or even support function or the risk officers, they do need to understand the benefits of derivatives, how to value them, how to assess the risk, how all through the food chain. It's very important that the overall capacity of the system is brought to a level of understanding that is necessary to support the development of that market. There's never enough capacity building in that field from our own experience. That's the main building blocks, I would say.
Okay. Thanks, Aude. Picking up on something you basically briefly mentioned, as you said, benchmarks. And what does it take to actually basically create, let's call it the building blocks for it? I know, Ramzy, I think Saudi Arabia has gone through, let's call it, certain different changes with regards to how to reform the benchmark, and it's probably still in the process of trying to work on basically going to the next step as to what does it take to build an RFR. And one of the building blocks for that, of course, for an RFR is the repo market. So maybe if you could tell us a little bit what, let's say, the journey of Saudi Arabia has been over the last few years.
Sure. Thank you, Axel, and good afternoon, everyone. Appreciate the time. A lot of what's been discussed already resonates quite a bit with what we saw in Saudi. Some uniqueness in that we had actually quite a bit of volume in some parts of the derivative market, FX swaps as an example. But this actually came about as we were looking to reform the SIBOR benchmark, so the interbank offer rate that we had in the kingdom, in line with what we were seeing in the rest of the world. And at that time, we were really trying to ensure that we first looked at transparency and how we can improve that. But this was a time, of course, where we were switching also from LIBOR to SOFR and other alternatives and other risk-free rates in the developed parts of the market. So we recognize that this is an area that we want to get to, but at the same time, we don't have a very active, secured overnight market in the kingdom. So this was one challenge that we wanted to take on, in addition to the benchmark update. But we wanted to also put this challenge formally to ourselves. So you'll see in the update to that methodology to SIBOR in 2020, 2021, we also indicated that there may be a transition at a future period to a risk-free rate post the analysis and development of a repo market. So really, we pivoted then at that time to what do we need to do on the secured overnight market. Many challenges and many building blocks to think about. Part of it was having a debt market, which prior to 2015 was really not active in Saudi at all. Much more in terms of debt financing since that period has allowed, at least for debt stock, to be available. And now you have at least buyers and sellers on both sides. The second element is really looking at liquidity providers and utilizers. Typically, you have pension funds, banks dealing with one another, and this is an area that's still under development in terms of extending the scope and profile of liquidity providers and borrowers. The third element, which I think we've talked about here today, and maybe we'll touch on a bit more, is on the legal and regulatory framework. What we try to do from our side is involve both legal, external and internal to the kingdom, and include the central bank, which is sort of supervising and providing governance with linkage with many multinational bodies like EBRD and ISDA as an example. The other element I would highlight is the infrastructure. Saudi is unique in that all the debt that the government issues is listed on the exchange. So in terms of transparency, it's really above and beyond what we see in any market globally. But this does entail some additional costs, some additional frictions, having to go through different middle market players. So we're really trying to take all these into context as we build this function up. The biggest challenge I'd say we had is doing all this development while also trying the added wrinkle of how do you make sure it's Sharia compliant. And this was probably the biggest challenge because maybe different than other jurisdictions. Here, each bank has their own Sharia board, and they might have a different opinion or preference on a specific transaction. So we tried as best as we could to start with the base, which was the GMRA, and we looked at it with the Sharia scholars as to what transactions would work best. We wound up with something that's called the double WAD, so essentially two options to allow for this. And we sat and discussed with every Sharia board one-on-one, and we wanted to make sure that every bank signed off. So whenever there was some trepidation or discussion, we allowed for a bilateral sort of annex that each bank could agree with its counterpart to make it certain amendments to change, just as one example, sort of interest on interest, how do you deal with failed trades, just because there is sometimes a different opinion from the Sharia standpoint. But I think overall that development has kicked off in the market, and we do see transactions, albeit I think there's still an element locally on the infrastructure side that we are working on. And on the international side, the netting became the most important factor that we were looking at. So the central bank really took this to heart, and they've released the draft framework that is currently under study by ISDA. I think once you have all these building blocks together, really the sky's the limit in terms of opportunity. And linking back to what we discussed, it does allow for the potential change on the benchmark at some point in the future.
Okay, thanks, Ramzy. Just thinking out loud, and maybe going a little bit off script, John. So one of the questions we sort of run into is that ISDA, of course, is an international, let's call it a cross-border framework. And a lot of the time they say local law will not allow local-to-local traffic unless there's a specific local law agreement. Do you see that in a lot of jurisdictions, or is that sort of unique to, let's call it, the areas where EBRD has been operating?
Yeah, Axel, thanks for that. I think that's an interesting question. I think the local laws where they restrict the flows, one example which I'd like to share to bring light to this issue is the emergence of NDF, which is the non-deliverable derivative, and then deliverable derivative. So the non-deliverable forwards, as they call it here, and for those who are in the trading, the NDFs, are financial derivative used to hedge or speculate on currencies that are typically subject to capital controls, convertibility restrictions in terms of what you can convert. Now, the existence of these kinds of controls or restrictions, sometimes create what we call the existence of both onshore and offshore FX market, especially in countries, as I mentioned, with capital controls. And these could create arbitrage opportunities, which will result in discrepancies between the onshore deliverable FX markets and the offshore deliverable markets. And what we are seeing is, in the furtherance of a developed market, this might not be a good thing because it creates pressure on local currencies to depreciate, where the offshore NDF rate for a currency is weaker, and therefore it doesn't reflect the fundamentals. The other thing that we're seeing is the regulatory challenges. Right? NDF markets typically operate outside the jurisdiction of the domestic regulators of home currencies, and therefore, it potentially could distort the currency value. And the other thing is market fragmentation. You have two prices. One price on the local markets, one price on the NDF markets. And the fragmented market, if it's not addressed, hampers the efficient price discovery in the currency at hand. Now, then the question is, what can policymakers, central banks, professors do to alleviate some of these concerns, frictions, or discrepancy? One example we have seen is easing of capital controls. So some countries have reduced the gap by loosening capital controls, by allowing more international players to participate in local deliverable forwards.
In other words, liberalize the markets.
Exactly.
NDFs are not new. They exist precisely because of, you mentioned capital controls, but also convertibility, cross-border transfers. So if they wanted to avoid the discrepancy in value, the offshore market, which ultimately takes commerce away from them, liberalize their capital market rules, essentially, yes?
Yes, exactly.
Yeah.
I think to your point, one live example is India. Right? India for the longest time
Great example.
were restricting this, but the last couple of years, India allows for international parties to participate in local deliverable forwards, henceforth reducing the gap, as we mentioned. That's a live example where liberalization does reduce the friction that we just mentioned. That's important. Then having access to onshore market, that is key. The other thing we have seen in markets that have this kind of discrepancy is more often than not, let's say in Africa, where you see central bank intervene. Now that's a very blunt tool because when you intervene, it sort of may not necessarily reflect the fundamentals of the currencies. And the other thing is, in order to develop a deep liquid market, we need to make sure that there are proper instruments in place to allow for a robust development. Like for example, issuances of sovereign bonds for a long-term maturity that allows for yield curve, and also allowing for a creation of a local repo market. These are some of the tools, but not exhaustive, that could go a long way towards developing a more developed, robust market, in addition to what was earlier mentioned about legal framework, netting, ISDAs. And like I said, it is not one tool, but it is a combination of factors that would sort of attract both domestic and international players to develop a robust, developed market. So Axel, it's a long way of saying it, but hope that addressed the question you just raised.
Well, yes and no, because of course, let's say there's so many nuances. This is one of the things that I think that sometimes I think is sort of not allowed to be talked about, let's put it that way, is that effectively for cross-border to be effective, you need to have almost like basically, let's call it, there's not necessarily a level playing field when you have, let's call it, developed market bank trying to transact with an emerging market bank. If the regimes are not deemed to be at the same level, let's call it the capital punitive, let's say, the capital treatment of that transaction can be quite punitive, and therefore basically making it more difficult. It's not just the capital controls. I think sometimes, I personally think we should look at some of the let's call it the international consequence of the regulatory framework imposed on developed market banks. So, and that's just a little bombshell. On the local one, I think the local ISDA one is that based on what we've seen, there are a number of jurisdictions where unless therefore there is a local ISDA, the locals can't trade with each other. And ultimately, interest rates in particular are set locally. FX is much more of a offshore, onshore business. But it's, as you said, basically it's the lack of unity of price that then actually leads to a problem, both for the central bank in terms of the managing of its, let's call it, monetary regime, as well as even for the market to say, okay, what is now the real price? Is the implied yield of 100%, is that the right price, or is the domestic yield at 25% the right price? And if the two can't connect, you get very awkward situations.
Yeah, exactly.
Yeah. Just if I may, another thing that parties may not appreciate is the price of a transactions where we have in a jurisdiction that have a higher AML KYC risk is the compliance cost, right? So there's always this attempt to say why is some of the emerging markets remittances more expensive than developed markets? Is precisely that because people do not appreciate when we move monies cross border. It's the cost of compliance, the AML cost, the CFT cost. Somebody has to bear that cost. And it typically is passed down to the consumer or counterparties. Because that cost, cannot be reduced to zero. Because otherwise, we're running in a highly unregulated business. So there is a statistic
which would not be desirable anyway.
Exactly.
We want to make it as smooth as possible, but still the minimum level of compliance.
Yep.
So there will always be this cost.
Yes.
But from a regulator or from a government treasury point of view, we want to minimize that as much as possible so that we can generate the business we're looking for.
Yeah. So henceforth, where countries where have robust AML CFT laws, there is the ability to reduce that because there are sufficient controls. But where there are none, it creates frictions in the ecosystem, especially through correspondent banking.
And this is maybe, again, it's a different point. Ramzy, one thing that I'm actually was pleasantly surprised by in Saudi Arabia is maybe two things. Is one, actually, the way I describe it, and maybe you can also sort of verbalize it. What I see is the importance of the open communication between the central bank and the banks themselves when you want to develop a system. And the second bit is a bit what Aude reflected to what actually, they say, Saudi is a pegged regime. How has it hampered or helped in some way the development of a domestic interest rate market?
I'd say maybe touching on the first point first in terms of the interaction with the central bank, I think it's really very strong, I'd say. So the reason I can speak about my journey with the repo and the benchmark was that as a treasurer for a different bank at that time, we had monthly meetings with all the banks in Saudi and the central bank, and various topics would come about. This is right after 2020 or just at the end of it. So we had gone through COVID, and let's say a lot more interaction was needed, especially given what was going on in the global markets and its impact in the kingdom. So I think their role is very important because they also help connect us with all the other regulatory bodies that are included. For the benchmark, as an example, the Anti-Competition Authority, but also with ISDA and other global participants in terms of understanding how they went through their journey. I'd say when we look at the second part of the question in terms of did the PEG help or hurt, I think it really depends on each country by country. The kingdom, obviously with the monetary policy that is in place, has been very clear for some time. And I'd say an added benefit is all the reserves that it has to shore up the position that it's in. So from a perspective of monetary policy, I think it looks very much exactly like what we see from the Federal Reserve in the US in terms of change and impact, barring one or two few instances where there was a slight diversion. But in terms of managing also what is going on in the market, almost daily interactions with the central bank in terms of understanding what's going on, what are people thinking. And I think that really helps in terms of execution on the monetary policy side. Lots of development in terms of liquidity provisions overall. And one of the main benefits why we looked at the repo is that it's a two birds, one stone situation where we can suddenly get better utilization of liquidity and more optimal utilization of capital, and at the same time look at a benchmark that is no longer forward-looking, it's more transparent, and gives you an option to really set the stage in the Middle East, similar to what we're seeing in developed markets.
Okay, thank you, Ramzy. Yeah, because I think for me, it's such an important message, even I think for a lot of countries we work in. The openness of communication between the central bank and the banking system is key. If you don't understand each other, all it leads to is, let's call it frictions. And frictions are the things we want to get rid of. So maybe turning back to, and I'll go through, not necessarily random order. Basically, in your experiences, therefore I'll ask the question to both John, Ramzy, and Aude. Basically, can you just, let's call it, maybe provide a picture as to what are some of the challenges or unexpected challenges you've had in trying to see a market go from, let's call it, either from 0 to 10, or from 10 to 20, or from 60 to 70. I think maybe I'll start with Aude.
I think the hurdles are generally more at the beginning and really the building blocks that I mentioned earlier, and they differ country to country. So it's not like all countries have the same problems. I mentioned the key role of, for at least interest rate derivative, the key role of anchoring interest rate expectations. That we've seen is the role of monetary policy, not only anchoring interest rate expectations, but also allowing for the development or supporting the development of an interbank money market, which is key for the creation of a benchmark. We've seen that this can be very challenging in countries. We operate in many countries with excess liquidity, so all the banks are generally on the same side, or they don't trust each other. So how do you create the environment from a monetary policy point of view that is supportive of the deepening of interbank money market, that is supportive of the creation of the benchmark, that is key for the development of derivatives? I mean, I'm just showing the journey in a sentence. So in some countries, monetary policy really needs to be improved to help support these interbank traffic and anchoring interest rate expectations. In some other countries, it's not only, I mean, obviously monetary policy has been key, but it's also practices of the banks. We've seen in even some countries where the banks only do 1 week transactions, and they don't see the benefit or interest of doing overnight transactions. So it's not only the monetary policy, it's also the mentality, the behavior, or how they've been used to operating, and they don't see the need for change. They don't see the benefit for the overall system to actually do a bit more, be a bit more proactive. The lack I mentioned, we've experienced issues at all the level, at every single step of the building blocks that I mentioned, but they are all very early stages. I mentioned the IT, the importance of the software for treasury, for booking and valuing treasury and derivatives operations, and the capacity building. We're seeing that really you do need to do a lot of work to really convince the banks, the regulators of the benefits of working and developing derivatives, because in many countries actually the banks are sufficiently profit making, and they don't really see the benefit of doing all this work. That's so it's really changing the mentality, the approach to managing the balance sheet. That is very important.
Yeah,
Thank you.
Just to add to that, in terms
Asia.
of Asia, what we're seeing is that lessons learned, like slowly loosening capital controls, allowing for access of foreign participant onshore, and financial and market reforms form key pillars in developing a robust market. Because if you look at examples in India, in China alone, if I recall, 20 years ago, when China was opening up right after, they get access to the WTO, they don't even have a bond market. Fast forward now, they have a very deep liquid market that, you know, with the yield curve, people could, you know, participate in a sort of a robust derivative as well as the cash market. So I think the issue now is the more you clamp down capital controls, you create frictions. And there's a cost to everything, right? So loosening liberalizations attract more players. And I do think, and that must be underpinned by a robust legal and regulatory framework, as we all discussed throughout the whole discussion. But I do think the ability to loosen, the ability to attract more players, because if you have limited players, you probably have less liquidity and concentration risk. So I think my sort of call to action is we need to look at it as not a cup half empty as opposed to a cup half full. How do we get more players involved? And how do we have public and private cooperation to develop a robust market? Not just cash market, but derivatives market.
Ramzy, any reflections from your side?
I agree with my fellow panelists quite a lot on these. I think going from 0 to anything or 70 to 100, planning is obviously very important, and recognizing that you can't do it on your own is critical. The public-private partnership mentioned, I think, is a key element. And I would say, even on top of that, we've talked about a lot of building blocks today. And sometimes we'll want to tackle one by one. But in certain situations, I think a lot of what we're talking about, sometimes you need to move in parallel across legal, regulatory, monetary policy, etc. I think another critical factor, skills and risk management in particular, developing there, because banks and financial institutions in general may be used to a certain way of dealing and transacting, and understanding the benefit of some of what is happening is critical to get there. We talked about the infrastructure. I think there an element of friction still comes up between how much balance do you want with transparency and friction in terms of cost. Communication we talked about as well. And I would say maybe finally just monitoring and improvement, because we're not going to go to 100 straight away. So if we get to 70, how do we make it 75? And I think that's a very important part of the journey to continuously improve.
Indeed. It's about evolution, not revolution. And yeah, because ultimately you need to bring everybody basically up with you, because people need to make basic changes uncomfortable. And therefore, the only way to solve it is to almost like over-communicate what it is you want to do, why it is you're doing it, and why it is in everybody's best interest to tag along the journey. Right, I think, I've talked long enough. I'm so conscious of time. And so not again, basically, I really do apologize for not being there in Aqaba. I had the unfortunate circumstance that not just my company banned me from traveling, but the flights were cancelled as well. Otherwise, I would have loved to have been there.
But nonetheless, Mr. Axel, expertly chaired, even from virtual premises. I want to thank you for moderating. I want to thank your panelists, Aude Pacatte, Ramzy Darwish, and John Ho. Let's have a round of applause. That was a very interesting presentation.
Thank you.
Thank you.
Thank
you. Top man.
Bye.
Right.
Thank you.
Okay. Doesn't time fly when you're having a good time? That's it. We're done for the day. Can you believe it? Don't go just yet. Don't go just yet. I've got some housekeeping for you, right? And then I'm going to summarize for the day. You want me to summarize, don't you? Right. First of all, as you know, there are 2 trips as part of the whole package. Tomorrow evening, we have the trip to Wadi Rum. And the day after that, we have the trip to Petra. And if you are interested in going to those, please register your name at the travel tour desk, which is just outside here. Okay, so the organizers will know what logistics. The guaranteed travel. That's the kind of name, you know, you kind of trust a travel agency that's called Guaranteed Travel, right? Okay, it's like a bank that's called Guaranteed Trust Bank, right? Yeah, I'll give you my deposit, no problem. Right, so please register. That's just a joke, right? Right, please register if you're interested in either or both of those trips. Please register at the Guaranteed Travel desk, which is just outside here, okay? And the gala dinner what's the difference between a dinner and a gala dinner? What's just someone that, right, okay. The gala dinner is tonight. When does that start? Gathering at 7:30. Where are we gathering? At the lobby. Okay, right. No, well, just here. Don't give me that false information. Don't give me fake news, my friend. Just gathering just outside here, in the lobby area here outside the event. No, I'm getting contradictions here. We need to be clear. Lobby of the hotel. Omar, don't give me this. You're stressing me out, my friend. Lobby of the hotel. Please gather at the lobby of the hotel at 7:30 local time for the gala dinner. Okay? Right. So now, as we've heard today, before you go, I don't know about you, but I thought that was just out here. I just thought that was a fantastic day's worth of conversation and presentation. Right from the start, we had Mr. Stéphane Malray talking about learning is everything, interpersonal, personal relationships, financial markets being all about learning and relationships. Never a truer word said. We had His Excellency, the Governor of the Central Bank, talking about adaptability, resilience, being able to maintain balance of payments in a frontier economy. A case study in effective central bank governance and management. I was massively impressed listening to that. We had the CEO of Arab Bank Group talking through about all the things that have made them so successful regionally, and I was particularly impressed by the emphasis on traditional bank values. They're a 94-year-old institution. Please invite me to your centenary party. And by observing traditional bank values, adapting to the times. For example, their emphasis on success is a journey, their emphasis on female empowerment in the industry, their emphasis on good customer service, tailored customer service. These are time-honored principles. I loved hearing that. We then went on to we then went on to someone who is basically either an energy source for the Cairo national grid one day, or simply a very good speaker at a conference, Yasmin Salah's conversation with Stephen King from HSBC about inflation, still not totally under control, so watch those dollar interest rate cycles very carefully. We then went on to the conversation about climate change. Yes, indeed, climate change, expertly moderated by Tessa Walsh of the London Stock Exchange Group. We could have had a whole day on that topic. In between that, we had a presentation on central bank digital currencies. We could have had 2 days on that one, okay, from my close personal friend. I only met him today, but he's now my close personal friend, Mr. John Ho. Where is he? Where's he gone? No, he's disappeared, right. He's become my close personal friend because I love this enthusiasm, and there's lots to talk about that. And you know what? That's also a bit like with AI, which we're talking about tomorrow. It's a topic that is not the preserve of large or heavily resourced banks. Any country, as we saw from his slide, lots of countries are looking into this area, okay? Lots of work to do there. The climate change I mentioned, and then we finally finished up with a talk about reference rates. I wish they hadn't got rid of LIBOR, but it doesn't really matter what I think, and had the importance of use of derivatives and all the things that the regulatory authorities need to concentrate on if they want to develop a liquid derivatives market, which, as we heard from the panelists, adds so much value to bank services by enabling them to hedge their balance sheet risk. Okay? When the former Federal Reserve Chairman, Paul Volcker, once described derivatives as not particularly useful, I think if someone had said to him, in most countries around the world, no one would do fixed rate lending if I couldn't hedge with derivatives, he might have changed his opinion about that, okay? Still, are you going to listen to the views of Paul Volcker or Morad Chowdhury? That's your pick. Right, that is today, okay? I'm going to bid you a good evening. I'm now going to go and have a sleep. No, I'm joking. I'm going to bid you a good evening. Please gather at the lobby of the hotel for the gala. Lobby, one of you, I'm going to murder one of you guys. Right, 7:30, lobby just out here, 7:30 just out here. That's the first, final, foremost. I'm going to set you and Omar together. You guys argue it. Right, 7:30 outside here for the gala dinner. I will wish you a very good evening. Take care of yourselves. See you soon. All the best. Bye-bye.